let me show my screen. There's a couple of technical things I want to cover. Blake's here with us this morning, and Steve is here with us this morning. And I even noticed that our guest is with us as well. So let me get to my looks here.
Good morning. Good morning to
See
everyone.
what's happening. See what's happening in the market. All right. I want to talk a little bit about, I already see face confluence beginning to build. Yesterday, Blake was talking about the dollar being at near the 61.8%, the euro was, of the recent rally. I started to talk about that there could be a third drive here. And here we are. This is a 15-minute chart that we're looking at right now. Can everyone see my charts? I'm looking at what the audience view is.
Hey Dale, all we can see is your face, and good morning.
Good morning.
Yeah. Good morning. Okay, I don't know. I'm trying to share my screen. Show screen.
There it is.
Okay.
You got it.
Thank you. All right, thank you very much. So we had some confluence, Blake talking about a potential low in the euro, and I said there could be three drives. Greg had popped in yesterday to show an Elliott wave count that allows for a recovery in the euro. Just one thing I want to point out, I'm a big believer in not going all in or going all out. You know, every once in a while we hit trades on the button, but that's the exception, not the rule. Usually there's some type of drawdown. You guys agree? I know there are some real accurate traders that they're right or wrong within a certain very tight area. But for me, I'm usually early. So I believe in putting a toe in the water and having a piece on that makes me pay attention to a trade. Give me a Y if you get that. That there's no law against doing two small lots that would equal one lot. So you don't have to be perfect on an entry, and it's even more important when you're coming out of a trade. It's always good on any suggestion that I make in the market. If you have 20, 30 pips made on the trade, I want you to book half and get paid that day, and then move your stop up to BE if the market says it's okay to do so, or at least tighten it to the worst that could happen to you is break even on the trade. We have a deal. You could do what you want with your calls, but whenever I make a suggestion, that's how you should handle my ideas. That's how I want you to manage risk. Give me a Y if we have a deal. Okay. All right, so this still is a possibility. I do believe that we are going to have a dollar rally. Just think about it. If you just had a great week being short the euro from 109, and you have the NFP coming up and other data, wouldn't you want to flatten out? So there could be some short covering that takes place here. I'm going to come off camera. My face takes up too much of the page. Okay, so there is a possibility in these three drive formations where you get a fractal. I label this drive 1. Everyone see it? It was a confirmed low on the euro. This is your 15-minute chart. Here's drive 2. It did not confirm, did it? So there's your first divergence. It's above 30. And then here's your third low. Here's your third drive. It's above 30. So this is why I'm talking about partial position. So the divergence held, your buy signals on the first positive candle, that was here at about 40. But there are times, and I didn't start noticing this till lately, where you could have a fractal, and on the third wave, it's really interesting. you end up with a 3 on the third. Here's 1, here's 2, and perhaps one more drive down. But my call on it is I definitely would not be short. It's one thing to try the reversal, but when you have this many non-confirmations on a trade, at the minimum, it's telling you not to be short. Anyone in here agree with me? Give me a Y. I know I don't like to be short when there's divergences developing. It's at least a warning sign that momentum is beginning to wane in that direction. Everyone with me on this? Anyone learn anything new? Yeah, that's right. And then just one other chart I want to show you. So I like this. I don't think it's unreasonable for a recovery in this market in front of the Fed. You probably have a whole lot of people shorts, people still looking for parity. Every peak is the next decline to parity. Why can't we see 107.60, which could be a nice little fib retrace, right? Oh, it's a pitchfork. You know, I used to be a broker and no one ever came at me with a pitchfork. So the fibs are inside the pitchfork. Here's a fib. So why is it unreasonable to see some type of recovery here off this third drive? I don't have to be bullish. I don't have to be bearish. I can just trade and take a look at some fib retracement levels. Okay, so this would be my first target. This is where I might take off a piece at 96. And perhaps we're going to make a run towards 107.60. The last thing I wanted to cover, because I want this not just to be a trading experience, but we're all going to share our wisdom in here. Okay, we all share our wisdom. So if you can learn, I'm really looking forward to learning from Blake and learning from Nicola and learning from Grega, because you know Elliott Wave makes my head explode. So I'm telling you, just to be able to pull up his work sure saves me a lot of mental anguish, because I know he knows. So do I have to become an expert Elliotician when I have access to one of the best in the world, or one of the best trader technical analysts, Blake Morrow? I have less pressure on me now than I did before 2 days ago. Okay. So the last thing I wanted to show was, and now I'd start to be careful being short yen crosses, but the Aussie yen was a huge winner. I wish we had started Friday. You guys probably think I'm making it up, but I made the call on the test of the breakdown up here. And yesterday I was talking about a rising wedge, and I put out the question to the community: how much will a market retrace of a rising wedge? And some people said 38%, some people said 61.8, and Midas, who's been with me a long time, knows it's 100%. Ladies and gentlemen, 100%. I rest my case. So this should go in your notebook now. When you're trading falling or rising wedges, you know what to look for now. Give me a Y if you know how to count an objective on the yen. You don't even have to get your fibs up. And if you learn something new, that's great. Okay. Someone's saying if you don't want to trade Euro USD, Euro Kiwi is starting to look interesting to the downside. Okay. I'm going to hand off to Blake here. I know Blake's busy. He trades his own account. He manages.
Hey, good morning, guys.
He runs a the best website on the net. I don't know how he does all these things. But
Hey Dale, how's it going? Can you hear me?
Yeah, he's a multitasker. Should I hand it over to you, buddy?
I can take over a little bit here.
Okay.
You know, yeah, I mean, I'd be more than happy to. And you know, really interesting that we're here. Let me go ahead and grab it. And you know, you were talking about a descending wedge. We have here. Hold on, really quick. I'm just making an adjustment.
Yeah, there it is.
Okay, so you know, the euro dollar we were talking about, the 618 holding, and actually ForexAnalytix, the Twitter account, actually just sent this out too. This is a you can see this is a breakout point.
Yeah.
And we're holding that breakout point. It's also the 618 that we talked about. Let me delete really quick. Let me delete this fib. I want to make sure I grab the right fib because it's overlaid. There we go. All right, so you can see the 618 is right within proximity, and I expected the dollar to pull back or bounce rather, and the euro dollar to pull back to the 618, and we're kind of here. And you notice over like the last two days, we really haven't gone anywhere. We've been in this maybe like 70-80 pip trading range, and we pulled back. And like I said, the last week the ECB really talked down the euro dollar regarding monetary policy. There were some comments that really, you know, broke down the euro last week. But
what did they say, Blake? Excuse me, Blake. What did they say? Did they talk about more QE or the program going longer? What was it?
Keeping it looser longer, basically.
Okay.
In a nutshell. And so that's what really hit the euro kind of across the board. And you see it slump against a lot of different currencies, whether it's the euro pound, which came down late in the week last week. Some of the euro crosses, like here's the euro Aussie, here's the euro Kiwi. They both came down a bit. Now, I do think that the euro is going to be very well supported here. If you just heard a jet, I'm near the Scottsdale airport, which has been very active the last 48 hours. Does anybody know what happened last night here in Phoenix?
No. What happened?
Final Four. So.
Oh yeah. Oh my God, yeah.
Yeah. So I'm very. When you're in North Scottsdale, which I am, you're within proximity of the Scottsdale airport, which it's only used really for Steve said he didn't hear anything. It's pretty loud because I'm pretty close, so you hear these jets, and we don't hear them that often because it's usually just private planes, but there's been a lot of jets because you have a lot of very wealthy people that have been flying into Phoenix for the last several days, and now they're all flying out. They're all leaving because the Final Four is over. So if you guys hear some jet, because I have the windows open because it's so beautiful outside in the mornings here, so excuse me if you guys pick up any of that noise. Anyway, going back into the currency market, looking at the euro dollar, we're within proximity of I believe a bounce zone, because you got the 618, you've got this upward sloping trend line here. So downside's fairly limited if you think about it from a risk reward standpoint. Like if I stepped out and bought the euro today, which I did, I bought it at 47 this morning. Think about what your risk is here. Your risk is below 106 for me. That's why I'm looking at it. And the reward is maybe 107.50, maybe 108. Any which way you slice it, my risk is defined. And as a trader, I'm always looking to define my risk. So I don't, my upside, I want to make sure it always outpaces the risk, but I want to make sure that my risk is very well defined. So that's like number one. Okay, where is the risk? That's the first question I always ask myself before I get into any trade. Where's my risk? Okay, great. It's identified. I know there's a line in the sand that I have to draw. Like for example, there's in ForexAnalytix, if you guys are users of ForexAnalytix, there's a pattern in play that was posted today on the US dollar Mexican peso. You were talking about a descending and ascending wedges, or you had an ascending wedge on the Aussie yen, which was a great call. If you look at the US dollar Mexican peso, This has been a very, very strong, you notice the downtrend line here? Let me just, I can move it so you guys can see it. Okay, you notice that downtrend line? That's been in existence since we peaked on inauguration night. Inauguration day, the US dollar Mexican peso spiked up, hit resistance, and then reversed. I mean, so within 24 hours of Donald Trump being inaugurated, the peso started gaining strength. And this has like been a 17% or so, roughly, rally in the peso. And before you were with ForexAnalytix, by the way, Dale, just FYI, if you look at the blog here on ForexAnalytix, we posted a blog about the peso literally a couple of days before inauguration. So that was on, where's the date? I don't know where the date is here on our blogs. I've never even paid attention where the date is. It's got to be somewhere around here. But it was, you can see where
that's it.
So you can see right here, right off the highs, and the peso it's been basically in nonstop free fall since then. So this is like the first signs that we're seeing of a reversal. Okay, now you talked about an ascending wedge coming out of an ascending wedge that you get 100% retracement. We may get 100% retracement, but what I like to do is I like to scale out of positions as they go in my favor, and I'm usually targeting certain fib levels. You know, I'll take a 38%. I'll take a 618, and so as we breach certain targets on the way back up, I'm always an advocate of taking profits when everybody else is trying to scramble in. I want to be the guy selling it to them. So when everybody's trying to buy something, I'd like to be the guy. Yeah, I want to be the guy selling it to them. Or when when everybody's trying to sell something, I like to be the guy covering. So in this case,
you're grateful for people providing liquidity for you.
Exactly. You know, that's it's always trying to be 1, 2, 3, 4, 5 steps ahead of the curve. That's the way I try to operate. I just want to try to be ahead of everybody else. When we trade, I don't use the analogy of gambling because we play a probabilities game when we trade. That's what it is. It's managing risk and identifying probabilities. Putting as many probabilities in your favor. But I like to use the analogy that when I trade, it's like playing chess. And when I'm playing chess, I'm thinking about 6, 7 steps ahead of you. Okay, so I'm looking at when I'm at a chessboard and I'm playing chess against you. All right, I'm thinking what your move is now. If I do this, what are you going to do then? If I do this, what are you going to do then, and what are your different options? And then I'm thinking 6 or 7 steps ahead of you. So what I'm trying to do when I trade is think about, okay, now that we have this ascending or descending wedge that's breaking out, well, the peso, people are going to start scrambling in, and I want to be the guy selling it to them. Now, the fact of the matter is I've been buying the peso since last Thursday, so I've been buying it since down here. There's really big divergent RSI on the 4-hour chart that's been cluing me in that we're going to see a reversal. So I've been picking it up for the last few days. And now, as we get above 19 and maybe to 1920, and maybe if I get really lucky, it back up to 20, which is the breakdown point over here, that's where I ultimately want to let everything go. Now there's a few things have to happen in order for that to happen. One of the major things being that we'd have to see some risk aversion. If we see some risk aversion, the
oil.
Emerging market currencies, oil too, could come under pressure, but really emerging market currencies could really feel some heat. So for me, I'm thinking, again, multiple steps ahead of the market. Okay, why would we get some risk aversion? Well, would
that be a surprise to the upside in the dollar, like the scenario you just described?
The dollar, obviously I'm long the dollar against the peso, but it's interesting because I'm short the dollar against like the euro from this morning. The dollar, the way I play the dollar against emerging market currencies is different than I'm going to play the way I'm going to play the dollar against commodity currencies or just maybe your European currencies. So in a risk adverse environment, the dollar should strengthen against emerging market currencies. How it's going to react, how it's going to react to like the European currencies, I'm not sure yet, because we haven't seen enough risk aversion in the markets, Dale.
Yeah,
We haven't seen enough. It's been a while. So to draw a conclusion on correlations at this point, it doesn't make any sense, because we haven't seen how the dollar will respond in a risk-off environment. So I'm not sure. And I think, and I always believe, Dale, that there is a trigger point in the market, and I don't know what the trigger point is, but there is a trigger point in the market. If things get hairy enough, fast enough, the dollar will become the default go-to weapon of choice for risk aversion. So in other words, if like, for example, if we were sitting here and we're looking at the S&P, and the S&P is down, like, let's just say it's down like 2% today, and then tomorrow, I'm just obviously theoretical, I have no idea if this would happen, but like, let's say it's down 2% today, and let's say tomorrow it's down 3%. So now over the course of 2 days, we're down 5%. And let's say then the third day, everybody expects a bounce, but the market continues lower and we drop another 2%. Now we're down 7% in 3 days. I would assume at some point, like in that ballpark, people are going to go, screw this, get me out and put me back into cash. And when people get into that attitude, that's when the dollar will trigger like some pretty massive buying. But I think we'd have to see some pretty aggressive selling in order for that to take place at this point. And I don't know what the number is. I'm just guesstimating. You know, I have no idea. But I do think that there is at some stage in the game, the dollar does play that role. And again, I don't know what it is, and I don't know when it is. And if you take a look at the S&P, I mean, the S&P, you know, let's all, you know, agree here that you know, the market has been explosive higher. It's surpassed so many targets to the upside. So many banks and the bank research that I read on a daily basis. I mean, we've hit S&P targets that most banks have targeted all year. Yeah, exactly. So here we are at levels that are probably a little lofty. So my assumption is, you know, we get like, this is really what I'm looking at. Speaking of a 618, we have this.
That's everyone take a picture of that.
Yeah, you know, if we get back below this, you know, 23.15, which, you know, 23.16, you can see we spike low right into the 618 retracement and bounce. That was last week. We get below that, and then we get below this trend line here. That was of the ascending wedge. We get back below that, and I think we will see some air come out of the balloon, if you will. And
I think that's called a throw over, Blake. Throw over. You know, people shorting up against the wedge line, and then it accelerates through it. And the throw over can make you throw up, if you're sure.
It's probably made a few people throw up as their accounts blew up or whatnot. But I do think if we dip back below there, we get below like 23.15. I think that accelerates the risk aversion, and then again, I don't know how the FX market's going to respond, especially in terms of the dollar. But what I do suspect will happen is the emerging market currencies will come under pressure in a situation like that. Now, you know, so again, you know, I'm looking at the euro dollar. Since we're not in a situation like that as of right now, I still look at the euro dollar as, you know, I can pick it up here on dips. I still think that the Fed raising rates, probably it's played itself out into the dollar over the last couple of years. You know, as other central banks look to normalize monetary policy somewhat, and especially with inflation ticking higher, I believe that the dollar is probably going to weaken moving forward, unless we see some significant risk off where it starts to impact you know, impact sentiment.
Does it look to you, Blake, like if it was able to generate enough juice to challenge a high from last week, that shorts would be under so much pressure that they'd squeeze their head so hard their eyeballs would pop out, and we can make a move towards 115 if we close over that level?
Yeah, I think so. I mean, this is a big inverted head and shoulder pattern. I think that the line is in the sand as far as traders go. I mean, you look at this, and anybody who's looking at the euro dollar right now knows that you breached this 108.50 to 109 level. It's free reign to make a move back up into the teens. So I think you're going to have plenty of selling interest as we make that approach, because there's a lot of non-believers. You understand that there's a lot of non-believers out there. There's a lot of people who think the Eurozone's going to hell in a handbasket. They think that Le Pen's going to pull off a Trump type of victory that's going to kill the euro. There's a lot of
Italy, you name it.
Yeah, there's a lot of people that are willing to take a shot short at the euro up there. So do I believe that
the pizza isn't as good in Italy? Another reason.
Well, I really do believe that in the event that Le Pen does not win, then we will have some sort of short covering rally in the euro dollar. Where does it take us to, and how high does it take us to? I'm not sure yet. I think there's got to be other factors that play into that. But the good news is, if you're a ForexAnalytix subscriber, we stay pretty well on top of everything, with all of our recent updates here, with all of our analysis throughout the major currency pairs and through the major instruments that we cover, that you stay pretty well informed, and even with the news links that we put up. So with that being said, I'm still paying very close attention. I did pick up the euro here because again, it's managed risk, and that's all I can really ask for in a trade. Where do I manage my risk? Where am I wrong? And right now I know I'm wrong below 106. If I'm risking below 106 and I can make back up to 108, I'm risking 1 to make 3, roughly, maybe even more. Let's say I get lucky and and end up holding it through the French elections. Then we really get a squeeze. Who knows? But I know that my risk is very manageable at this point, and that's what's most important to me at any given time.
And you hold positions through red events and like elections and the NFP, because I know I've talked to you several times, Blake, and you said you're hardly ever flat. You always have, at least your toe a few feet in the water.
I do.
So
yeah.
you trade through all of this noise.
I do. I always keep something on. I do that for a specific reason, because I'm the type of person, if I don't have anything on, which there are times, if I'm going on vacation, that I'll take everything off. My head automatically just checks out of the market, and then I stop paying attention to every little tick in the market. And for what I do and the amount of money that I manage, it's important that I'm paying very close attention to what's happening at all times. So I usually will have 1 or 2 trades on, even if they're small, if relatively speaking, for what I'm doing. And small for you could be, 1 micro lot, it could be 1 standard lot, it could be, $1 million worth of currency, whatever the case may be. I always try to keep something on. And even if I've got something on, that means I'm constantly will be looking at my phone, and I'll be reviewing prices and seeing where everything's at. Once I take everything off the board, then I don't do that. And
what a great segue! I was just going to show the phone app video on my bathroom break.
Awesome. Well, I'm gonna pass it back over to you guys. When we come back from Dale's break,
Blake, this is so cool. I mean, I get to interview you a lot.
Yeah, absolutely.
It's really cool. It's kind of like we have our own little. It's like Kudlow and Kramer or something like that. Anyway.
Hey Dale, I passed it over to you. Steve's trying to say something, but I passed it over to you.
Blake, we have a couple of attendees that have asked a couple of questions from you specifically. One has to do with your view on Aussie. If you want, I can take them over the Aussie, and the other one has to do with the Bund, actually.
Yeah, actually, I can address that when we get back from break, after Dale puts us on break
Sure.
for a minute. I'd be more than happy to address those.
Sure, perfect.
Okay.
The Bund. There's the Bund.
All right, guys. Well,
okay. All right, so I'm going to take 5, everybody.
and so will we.
And I, you know what? What's great is there's now a phone app. Now, I'm not a big phone guy, but I know I see people, they never stop looking at their phone. They never stop looking at their phone. So I'm just looking for it.
Well, Dale, one of the things about having an app is the mobile flexibility. And when, I trade for a living, and I trade all the time, and that means I'm looking at quotes at least, for me, at least 18 hours a day. So when I'm at baseball practice with my kids,
a very special marriage.
Or when I'm at the grocery store, if I'm getting an update on a mobile app, that's the best thing for me, because it's really difficult for me as a trader to look at the charts when I'm mobile. So if somebody else does the work for me, that makes a lot of sense. Okay.
So it's not a luxury; it's a necessity. It depends on your style. But all I know is if I'm having dinner and something breaks in Europe or Asia, that I can get an alert and be able to consider it. I'd rather have that happen than wake up in the morning and go, oh my God. Who's ever woke up in the morning and said, oh my God? So anyway, here's a look. Here's a video of the phone app. So I think, did Blake answer your questions about the Aussie?
No, but I can do it really quick, and then I'll pass it back over to you, Dale.
Yeah, didn't we get to like Greg's targets? I noticed on, I got that alert. I noticed on the, okay, go ahead.
Oh, on the Aussie? Well,
oh no, it has to take that low out. Yeah.
Yeah, so if you look at, and you can actually pull up Greg's analysis here in a few minutes. Right. The Aussie, in my opinion, it's trading pretty heavy. But here's the kicker about the Aussie. I mean, this little breakdown below this trend line, probably got some longs liquidated. Right. But the one thing that I'm really paying a close attention to here, Dale, is the strength in gold. And the Aussie, for all intents and purposes, as long as it trades below 78 cents, it's not bullish. The risk reward in our analysis from last week was, as we were trading above 77 cents, it's like it's set up for a short here. Whether you believe it's going to break out or not, it's the risk reward favored shorts when we were at 77 cents. Then
it found 61.8 after the first break. Classic, Blake.
Yeah, and it did. It pulled back to the 618. But here's the thing. If gold breaks higher, I don't know if I'd want to be short the Aussie. I'm long the Aussie New Zealand. I've got a longer term position in the Aussie New Zealand that just bounced off of the broken trend line actually this morning, right here around 108. But as far as the Aussie dollar goes, as far as the Aussie dollar goes, I just don't know if I'd want to be short if gold breaks out. And gold looks pretty bullish. I know it's pulled back a little bit from key resistance. I mean, if you look at here, let me pull up gold really fast. We pulled back from key resistance today, the 200-day moving average. But if it breaks, I don't know if you want to be short gold or short Aussie.
That looks like Custer's last stand, today's candle, Blake.
Well, it does. It's early though. It's still very early, to draw any conclusions on what we're going to look like by the end of the day. I mean, we still have, a good, 7-8 hours of the most active time coming up.
You think there's a few buy stops above that? My handle is Forex Stop Hunter.
Oh my God! There
and there, and the previous high.
Yeah,
at least a one lot, don't you think?
Well, I believe that if we break through this, that we should challenge this massive multi-year downtrend line pretty easily. So if we trip stops above there, we're going here. And again, this is my opinion is I don't know if you really want to be short the Aussie if that happens. But you know, we're really close, and I'm not saying that gold is going to break out. Even this morning, if you read the analysis that I put up, and I did it, so I know what it said. On the analysis this morning, I said gold has rallied in the resistance zone, which may set up as a good risk-reward short. However, if broken, it would be very bullish. And really what I was saying there is just what I told you guys. You know, if it breaks above here, it's bullish, but it's a good risk-reward being short, and that was at 1257, and currently we trade at 1254. And so if you were, you know, if you're like, oh, you know, and you're reading the analysis and you go, oh wow, that's a good setup for short. Yeah, I mean, you're up $3 right now, because it is. I mean, you know, again, whenever we trade, the most important thing is identifying where the risk is. So, you know, as long as you know where your risk is at any given point, whether you believe something is going to happen or not is irrelevant, really. Now, so I answered the question about the Aussie. I had a question about the boons. I mean, boons have rallied off of support. And I'll tell you what, if you're short bonds here, or boons, and bonds the same thing if you look at the 10-year or the 30-year bond market. I mean, we had a false breakdown, okay, in boons, and we've ripped. I mean, we're at the 50% retracement right now, and the analysis that we wrote yesterday on ForexAnalytix said looks like we can test the underside of this the previous support here. Now, I'd venture to guess that boons can go a lot higher because everybody is short.
Bearish.
Yeah, everybody's bearish. Bonds, boons, baubles, gilts, you name it. They're short them.
And they're bullish stocks. They're bullish stocks and bearish bonds.
Right. Yeah. So I mean, could the boon market be setting up for a massive squeeze here? I mean, could we you know rally to like 165 here on the boon DTN? I mean, yeah, I think it's entirely possible. It would probably go hand in hand with a rally in precious metals. But anyway, but that's my thoughts. I don't trade boons. I'm just, you know, I do analysis on them, just, you know, paying close attention to them. But that would be my take on the boon market. So, you know, with that being said, Dale, I've taken up enough of your time. I'm going to pass it back over to you and see, maybe Steve might have a few comments that he'd like to throw out there too. So it's coming back over to you. You should see the screen.
Yeah.
Okay.
And thank you so much, Blake. I learn from you every day, man.
My pleasure, and that's what I'm here for. And you're welcome. You're welcome, Steve.
All right. Good hunting, bro.
Thank you, my man.
Go ahead. Steve.
Hey, Dale. Hey, everybody. This is Steve Vouleridis, also from ForexAnalytix, obviously. We can go over a few charts. I think that actually Blake set the stage. He actually went over a couple of things. I would want to talk about Dale, but we have plenty more to talk about. You want to pass me the screen?
Yes, sir.
Okay. First of all, I would like to start. Let me choose which screen to share. Okay.
Hey, Steve, I have a clean screen today.
Okay. Can everybody see my screen?
Not yet. Now.
Oh, okay. Good. Okay. First, let's begin by the boons. I know Blake went over them, but something that he forgot to mention, because it doesn't matter anymore, obviously, is that here we also had a very clean head and shoulder formation, and that was the neckline we rebounded from. So,
nice.
So the options here are quite simple. As you see, the boons, for obvious reasons that started, I mean, the initial pressures higher, besides of course the monetary policy, etc., had been with the whole mess in the Eurozone, in the European Union. that got bonds obviously bought, and monetary policy and ECB loosening, and then ECB's QE, etc., everything put a bid, plus the correlations, plus the fact that it's obviously a safe haven. They got in an equivalent path as obviously the treasuries, and they also broke down with them. But as we see here, we had a very clean head and shoulder formation. But as we very often say, a head and shoulder formation is only such once you break the neckline. Currently we're rebounding. The initial version could have easily been that this was simply, as you see, a bear flag. Obviously, we've broken above it. We're currently testing a horizontal support. We have the 61.8 fib higher. Generally, as you understand, if bonds do not turn lower and do it soon, all this was just like a major consolidation after a huge multi-year rally. And as you very well know, Dale, more than the average person, trend is your friend, etc., 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 and you should look into buying opportunities. Obviously, political risk is going to play a huge role here. Somebody mentioned before in a question, they mentioned that today we have the second debate in France. So whatever happens with Le Pen was not really good in the first debate, so that put a bid on the euro.
Could I ask you a technical question on the Bund chart you just had up, Steve?
Of course.
Okay, so if you could put that up again, it showed a long-term uptrend going back to May of the year before, and then the last, and since 2016, the trend was interrupted, number one. You had the makings of a head and shoulders, but to me what is most interesting is even though we were in very sharp uptrends up until this year, looks like volatility's expanded.
Yes.
Okay, so volatility, have you ever heard this expression? Markets top in violence and bottom in silence. And to me, the treasuries, even if they can blow off and make a new high, the character of the market has changed in the last year, where it's much more volatile, which is great for traders.
I agree with you, and you know something, our other partner and contributor, Stelios, which is currently in London for business, will join us next week. I would like very much for us, I mean us three, to get here and make a conversation about macroeconomic drives for the euro and the bund and everything else, because I'm an economist. Stelios is also, you know, a person that's writing our macro part of the site, and he's excellent in his macro view. And we can have a very prolonged conversation about the macro factors that drive this. So instead of trying to squeeze this within, let's say, 5-10 minutes that we have, I think it's a better opportunity if we postpone this conversation and have it, the three of us with Stelios. I'm sure it's going to be a very interesting conversation for people. But if I should briefly say here, listen, I do believe that the divergence between the monetary policy of the US and the Eurozone is most probably closer to the end than near the beginning. Personally, I see a lot of hawkiness on the side of the Fed. I understand the reasons, but we are already in a very, very prolonged stage of this business cycle. I really don't see the Fed normalizing monetary policy on time before the next recession, but this is a huge conversation. On the other hand, as you see, the economic indexes and everything else looks better for the euro. So if the Eurozone avoids some culprits that have to do with political risk mainly, first of all, let me say that I believe that the chances of a Le Pen victory are very low. And this comes from a person that believed that a Trump election was quite a high probability, and also believed that the Brexit is also quite a high probability. So I'm not an optimist in a sense, you know, I wasn't following the crowd in those kind of predictions. I was way more moderate. I'm not going to say that I predicted it, but I would say, for example, that I bet on a Trump victory because I believe that it was very, very much, taking less into account than it should, because the populist drive was more than obvious, and the appeal of Trump's words. But anyhow, that's another conversation. So let's go back to the technicals, and next week we can have a couple of webinars and talk about macro stuff. So this is one that has to do with the bond. So I'm on the same page with Blake totally, but I also wanted to note the head and shoulders. Blake already talked about gold. This is the third test of the 200 DMA, and let me remind something. This huge trend line that we're testing, actually you can see it better on the weekly. This huge trend line, if we break above this level, 1260, then the only resistance left that is of importance is this huge descending trend line that in essence has kept gold subdued since the top of 2011. So a break above 1260 should target 1280. A break above there, I would definitely not want to be short gold for any reason. Needless to say, since we are at precious metals, that the situation with silver is, I would say, quite similar. As you see, this is a very interesting chart. Why? We have some levels here. First of all, silver was at a prolonged downtrend. We had a very, very, very clean bottoming pattern. I mean a descending wedge. We broke above it. We made an impulsive run higher, and then we corrected within a channel. This is a channeled correction. We found a low at previous peaks and horizontal support. We broke again above the channel, came back, retested it to the pip, and now we're testing the highs again. A break above 1850, also I wouldn't want to be. Actually, to be perfect, for full disclosure, I am long silver. I've been long silver since we broke this level, and I will remain long silver because also fundamentally speaking, I'm a firm believer that the equilibrium for the metal is quite a lot higher. We can have that conversation with Stelios as well. So somebody else asked about the Aussie here. Blake already went through everything. I just want to remind the bigger picture because, you know, I also always want to take it, you know, from the big picture and down. I remind you, Aussie had blown up like a billion accounts. I remember articles and bank research and everything else telling us over and over again back in 2011, 2012, how much overrated it is. They were actually right, but as you very well know, macro factors, Dale, are not triggering events. At some point, the market will decide that something is important, and when it decides that it's important, it will then start following, you know, reality and the macro. The same thing that happens currently with the S&P. So we broke down, and then we were in a prolonged coiling triangular consolidation. We had a false breakup. We had a breakdown. In essence, currently the market is going nowhere, as you see. But we can trade the technical levels. Those horizontal support and resistances were already there. As you see, we've respected them several times. We broke below here. The next support is around 75. We break below there. That's quite bearish, actually. The next serious support is a little bit above 73. But currently, as Blake said, my initial reaction would be, I don't want to be long Aussie as long as we stay below 77.50, 0.7750. Now, as far as you're testing here, the risk reward was excellent to take a short, as the short with gold that Blake described before. Currently, if you told me to take a position from current levels, I wouldn't want to take one. Actually, if I was forced with you know, a pistol on my head, since we're testing the 200 DMA, for a scalp, I would be most inclined to go long than short, but I'm not a scalper, by the way. So, you know, take that with a pinch of salt. That's not my trading style. Never was, never have been, and I don't think it's going to change at this age. So, Kiwi. The situation with Kiwi was much more clear. It was much weaker, and that's also the reason why we were long Aussie Kiwi. A clear level here. As long as we stay below 71, there is absolutely no reason to be long. But no matter what, at least a break of 72.30 is needed to open some upside again. But also Kiwi, if you see, it is in a choppy consolidation. Yeah, we get some, you know, we get some big rallies, some big sell-offs, but in essence, we haven't gone anywhere since almost a year ago, like 9 months ago. So those markets are, you know, the same with USD CAD. I mean, USD CAD, you know, as we often write in our analysis as well, the situation is very simple. Sometimes you're monitoring a market and you don't see something that you like. It's okay. We have so many FX pair and so many other markets to trade that it doesn't really matter. You see something that doesn't inspire you, just go to the next. It's okay.
And then there's Peter's screen. And Peter, can you hear us?
I can.
Hey, Peter.
Hey, Peter, how are you?
Awesome.
Welcome to our house.
Yeah, thank you very much for having me again.
Welcome, Peter. It's Steve. By the way, sorry, Dale. Go to webinar crashed, so I'll let you do the interview. I don't know up to what point you heard.
Have a great interview, gentlemen.
Yes.
Thank you very much, Blake. Don't worry about it, Steve. Very good presentation. So, Peter, welcome to the face community. So, I don't know if you want to show your face or show your charts. But you can share your screen.
How about now?
So everyone, I want to tell you a little bit about Peter. I met Peter on Twitter, and we started tweeting, and I invited him for an interview, and then we had kind of a inside joke together. And I talked about that when I was interviewing him, that I thought there was going to be one more slide in the S&P. Right, Peter?
Right.
And you didn't, and there was, and the bet was, if it happened, he'd have to buy my old Ford Pinto. Okay? And you did. You had to buy it. You bought it. You said you picked it up.
No,
it's
hold
an
on.
imaginary car.
A second.
Huh?
Let me correct myself. We had a double bottom back in February. The summer 2015 low was retested. We had a double bottom, and I said from there on, back up the truck, right?
Right. Well, right. Well, how did you end up with my Pinto then?
Well, I had it refurbished. It was remodeled.
Oh, okay.
You're gonna love the picture. You're gonna love the new look of it.
I can't wait to see it. Maybe you'll drive to California. Where are you located again, Peter?
Florida.
Florida. Okay.
Long drive.
But I do recall the tweet and not the day that you said, Dale, I'm now backing up the truck.
Right.
And I'm backing up the truck and I'm filling it up. I'm buying as much as I can.
Right.
When was that, pre-election?
That was, you know, I called the low, you know, when the double bottom happened back in February. That was it. You could have bought in the summer at the low.
Right.
August 2015, you would have been perfectly fine.
Yeah, but you sent me a tweet. I remember the tweet you sent me was right before we entered a blow-off stage to the upside, where things really just became vertical.
Yeah, everything was pointing to a blow-off from there. I mean,
so what's interesting to me is I got a recent tweet from you that you think that in the next couple of weeks, this advance could run into some difficulty. Am I reading that correctly?
The high in some indices is not in yet. Some indices. I think the S&P and the NASDAQ still have more to go. But we're in the final stages of this advance that began from the largest degree of trend. I say it started at the low of the flash crash of 2010. That's one large wave. now, the advance, and it's in its final stages. The fifth wave of that advance began at the low of February 2016.
So this is 5 of 5 of 5 of 5 and completing something?
Actually, the coming high will be wave 3, or I'm sorry, wave 3 of the largest degree. In other words, the third wave of the trend that began on March 2009 is about to end.
I see.
Wave
so
3, bull market that started 10 years ago.
So we could have fib retracements, even a 23% retracement of that move would be a pretty big hit to the market.
We're going to have a 50% retracement of the rally that began at the low of 2010. In other words, we're going to revisit the 2016 low. Everything that happened from 2016 up till now will be revisited. You have screen sharing on?
Yeah, there is a screen sharing. I'd love to see your charts.
What do we have on the screen right now?
You're the presenter, so right now I just have you and me on webcam, and you're showing your desktop. So if you could
My regular desktop. Okay, let me switch over to the second monitor right here. Do you see any chart?
Now we see it.
Okay.
Okay, we see the trannies.
Let me talk. Yeah, so the trannies, in my opinion, have topped for now. And you know, when we talked about this post-election move, which began, of course, somewhere in the summer, October, I would say, July, summer 2016, we started seeing evidence of a breakout. And it was all based on the pattern that I captured right here. Mm-hmm. And I thought that the first hurdle would be here, the 1.618 extension of the XA leg, which is 98.53. We came awful close. We have from a Tom DeMark perspective, we have a 913.9 that will be registered at the end of this month. There's a 913 here. It led to a brief pullback, 3 months pullback here.
Are those numbers, Peter, Tom DeMark stuff, the 9 to 13?
Those are DeMark stuff. So that 13 led to a pullback. It was a partial retracement of the rally that precipitated, or that came on the heels of the February low, and then we took off. And eventually we're going to get up here at the 11,000 on the trannies, but not now. So I think the trannies, if I'm not mistaken, may have topped for the year. On the smaller degree of trend, I can see a terminal diagonal there. So there's a possibility the trannies have already topped. I believe the bank index, the NASDAQ banking index, it hit a very crucial area for me right here, the top of the Andrews pitchfork, and this alternate bad area. It reached the top of that area before it turned back down. This is institutional selling on the financials, if you ask me. But as you know, institutions, they unload in phases. They cannot crash the market by unloading everything they got. They do it in phases. Every new rally is an opportunity to sell. Eventually, the banking index will reach much higher, but not now, not now. I think this might have topped for now. The S&P, here's the double, well, that was the February low, and if you look at it, it's an ABC decline. So the summer low was right here. We came back down and tested the October 2014 low, completed an ABC. And that was good enough for me to call for the fifth wave in blue. So that's the lower degree of trend. That's what we were talking about a second ago. So if my analysis is correct, blue wave 5, which began, which is associated with this 5-wave run that began at the low of the flash crash 2010, 1, 2, that's 2011, 3, 4, 5 is supposed to end here. I don't think it has ended yet. I think it still has a little more to go. Once it reaches this area, we're going to see
2,500.
Yeah, we're going to threaten 2,500, and then we're coming all the way back down here from the bottom of yellow wave 2 or orange wave 2, which is where wave 1, blue wave 1 began. That's the flash crash low. This whole thing is a 5-wave move. Once it ends, a 50% retracement will take us back to the low of October 2014, which is also the low of 2016. So we're going to have that, and then that will give, not will because there's no guarantee, but I believe that this should be the start of orange wave 5 taking us towards 2,900.
Wow, interesting.
Okay.
You know, I have a question for you, Peter. I see you use everything. You
Right,
use
I use
Onyx,
a lot of things.
you use Tamar, you are an Eliotician. Which of these, in your view, having been a practitioner of all of these, is the most reliable, either standing alone or in combination with?
I don't believe there's any one thing that is reliable. One mentor told me a long time ago that technical analysis is like prosecuting a court case. The more evidence you have,
I've used that metaphor, yeah.
you know, so you
So
have
confluence.
to have
So
evidence.
confluence is a big deal for
Confluence
you.
of evidence. That's right.
Okay.
So that's where I think the best opportunity for buyers is down here. And right now there is definitely evidence of systematic unloading of risk. It's happening slowly in a stealthy fashion, and it will take
Where do you
weeks and
see it?
months.
How do you know that? Where do you see it?
Well, I see it in utilities, for
Okay.
example.
And the bond market, so you're saying
The
people
bond
going,
market has begun to turn up.
right, so it's
You know,
people beginning to seek safety and the gold on the verge of a breakout, that
that's
too?
right.
Okay.
You know, I do like the configuration of the gold chart right now, that there's an opportunity in gold right here, especially if it breaks above the previous high. But the bond market, I was looking at TLT earlier, the 10-year,
Yeah.
and I do like it where it is right now, even though
I was
play it.
thinking at the minimum, why not fill the gap at 130 on TLT?
Yeah, why not? That's right.
You know, if not, there were only 2 drives, you could even get another high out of it.
It's very possible.
And don't you think that would happen once 5 completes and it's on its way to 4? That those moves accelerate?
Yes,
Okay.
and that's what happens during the formation of a top. You see money flowing out of the risky assets slowly in a very stealthy manner and slowly, going into these safe dividend-paying stocks too. For example, I was talking earlier about the XLU. You'll see the XLU has formed the double bottom right here. Not the XLU, but relative to the S&P. I look at the XLU relative to the S&P. So that's a relative strength ratio chart.
So it's starting to show higher lows, higher low.
Right. Well, here's the XLU from 2009. I see here a cup and handle. You had that post-election reaction. But these two here, this is called an ascending base. This is a very bullish configuration for the XLU.
You think we could get a 50, 60 VIX reading when that wave 4 begins? I mean, we're so compressed in volatility, Peter. Isn't that, like markets top in violence and bottom in silence, and people aren't even buying protection anymore. They're going, you know what? It's a waste of money.
Right.
Why should I buy options that expire all the time?
Here's the thing. The smart money protects in various different ways. They collar their positions using options.
Yeah.
They rotate into other assets. They diversify. They don't always buy VIX to protect. And VIX, that's a sucker's game, in my opinion. It's just
or S&P puts.
Or puts, But I always recommend for those who have stock positions that they don't want to let go of them. They want to hold through thick and thin. Why don't you use the options collar strategy?
Oh, so you strangle it? You just strangle, you sell puts above and sell calls underneath?
No, well, with the collar strategy, what you do is you sell covered calls, and then you use the proceeds from the call selling to buy puts. So that protects you against the downside, but you finance that through the selling of calls. I have a video on that, by the way, that I've recorded. It's a very extensive video on the collar.
Do you do anything? Do you do anything in currencies, Peter? You know, that's our big league in here.
I know nothing about currencies. I don't.
All right. Do you follow the dollar? Does that come into the mix at all?
Every once in a while, but it doesn't come into my analysis. In my model, the currencies don't play a role because, you know, here's the thing. At some point or another, it's 6 of one, half a dozen of the other. If you look at enough things, you will get the signal that you need. If you look at too many things, you'll start suffering from analysis paralysis. And that's not something, you know what I'm saying? So a couple of indications, by the way, that the rally was about to expand, you know, around the elections. Here's the SOX versus the S&P. It has been such a reliable indicator for me because back in 2011, February 2011, this ratio, the SOX versus the S&P, reached the 2007 high that preceded the crash, 2007-2008 crash. And then we formed a bottom. We had a bottoming formation right here. We rallied back to it, 2015. That signals the start of the correction.
Right.
And then here, when we finally break through this 2007 high, this double top, that was an indication for me that the market is about to take off like never before. Yeah. And look where this ratio is. I still think that the semis are the biggest opportunity in the stock market for years to come. Gaining,
do you think there could be? Do you think that if after we get to 2,500, when, you know, all the caveats, and we get retest back to last year's lows, that the semis might retest the breakout? Yeah,
I think it would retest the breakout. It's going to come awful close to it. It's going to be at least a 20% correction, maybe more. And you know, when I tell people that, they don't believe it. But listen, I mean, so far, everything that I've used in my model has served me well. So I have no reason to believe otherwise. Okay. So, but listen, that's not how I trade. That's not how I trade.
Anything on oil? Because oil's a pretty big component. You have a view on the oil shares or the oil?
Well, I was looking. Yeah, I mean, that sector is, I mean, when you look at, what is it, USO, United States Oil, the ETF, it's, I mean, that sector, the oil sector or the energy in general is depressed, and I'm not sure I understand why that's the case. But that's also a telltale right there. That, you know, here's the thing with oil, it is always subject to geopolitical things that are beyond my comprehension. So I do not include it in my analysis. I don't. I look at it, yes, but I really don't use it as a premise for what I'm going to do as on a week in, week out basis, because from a trading standpoint, I'm mainly an options premium seller. That's what I do.
I have a neighbor who's from Israel, and he says every time oil gets too low, ExxonMobil starts a war.
Right. Yeah. You know what? Yeah. You know what? That might not be an exaggeration.
Yeah. So, you know, we had that $25, $30 oil. Let me ask you this: the Saudi Aramco deal, could that also be kind of a tell that why are the Saudis, after all these years of reaping billions and billions and billions, are going to let the public buy into their deal?
I don't know. You tell me. You probably know.
I don't know. I'm always skeptical when someone goes public with something that, you know, why do they need anyone else's money if it's so great?
Right. Exactly. You know, eventually this oil, the whole oil business, even, you know, eventually we need to forego the reliance on all that stuff. And, you know, with You know, we need new innovative sources of energy, and oil isn't one of them. So, you know, whenever you hear commercials about buying oil wells and things like that, you know that it's a done deal.
I wanted to ask you, Peter, when it comes to time, do you do anything with, like, you have these views and you have numbers, but Gann was pretty big on time. Do you have any ideas of, like, timing wise, that perhaps this is a second half story, that, you know, maybe the S&P's pull back to 22 and a half and then make that run?
I've always tried to incorporate time into my analysis, and even though Gann believes that time is even more important than price, I've learned to stay away from timing things. All I know is one thing I can tell you is that when the market is ready to crash, it does it on a Thursday or a Friday when options premium is at its lowest. Okay.
So the option writers are going to have a bad expiration coming up sometime this year.
Exactly.
They write them. They write them.
So in summer 2015, I called for the crash a week ahead of time. I said by next week we should be in crash mode, and that happened. So
give me your notes through ghosting, that the market will top by then and will begin this retracement by then.
I think by, you know, sometime this summer, after this earnings season is over, we're gonna start seeing a top forming. We haven't seen it yet, not in the S&P, not in the NASDAQ. So until I start seeing a top, I can't.
Would you say the Russell, which has been demonstrating relative weakness to the rest of the market?
So the Russell is starting to lead. Now here's the Dow, and I'm going to show a similar chart of the Russell. Here's the Dow. That's a chart that I published back in 2013. It was still at 14,000. Everyone was making fun of it. And look how nice that happened, that Andrew's pitchfork right here, this channel. We rallied all the way up to the top of this channel, and then we came down summer 2015, retested the 2014 low. Notice that in February 2016, we didn't make a new low on the Dow. We retested. It was like a double bottom. And then we rallied up to the measured move of this formation. So I'm very, very concerned about the state of the market right now. I'm not buying any indices yet, even though there might be an opportunity coming up very soon in the next few days. But it's going to be the last hurrah for this market before we come back down all the way to the 2014 and 2015, 2016 lows.
Yeah, wouldn't you think they'd want to take them out, Peter, just to scare everybody and trade, like, you know, 1790,
they might,
1700?
It is very possible, Dale, but it is very possible. It's not out of the question, but for me, fourth waves rarely ever exceed a 50% retracement. So, so that when I measured the retracement from my upside target, and I said, what would a 50% lead to downside, from a downside perspective? It was, you know, it was right there at the 2015 lows. So if we reach that 2,500 and we get a 50% retracement relative to the rally that started at the low of the flash crash in 2010, we get a 50% retracement right there at the 2015, 2016 low. So it works out nicely. And, you know, one might think, well, that's all coincidence. I've seen it way too many times. And it's almost like there's an invisible hand that engineers all that stuff to happen right when it's supposed to. Here's the Russell, by the way.
Yeah, the master mathematician who designed
You're right.
the universe.
You know what? You are absolutely right. There are hidden hands and forces that we don't understand, but if you really dig deep, you'll find them. And that's what I think here happened. You see that you did get a low in 2016 on the Russell. It was the C wave of an ABC here in purple. And I think right here we have a 913.9 on the DeMark count.
That's bearish.
Very bearish. 913.9. The fifth, there's some sort of fifth wave here.
Yeah.
This might have been 1, 2, 3, 4, and 5, which I don't show the higher degree. So I think at some point we're going to come all the way back down here somewhere. Okay.
What a great interview, Peter.
Yeah.
You know, really, thank you so much for edifying our community. I mean, a lot of people in here trade FX, but I guarantee you they all have retirement accounts.
Sure.
They're all in funds, and you know,
this is the time to start protecting. This is the time to start implementing some protective strategy.
Okay, that's a great message. Look to be hedged in an effective way as we go through the year. I've seen Peter be very accurate. Thank you for edifying face. It was great to see yours.
I appreciate it. Thank you very much for the interview. It's always nice to talk to you, Dale, and I appreciate the exposure. Okay,
and stay away from Mar-a-Lago. It's going to be busy with the Chinese president there this weekend.
You're right. I should skip town. You know what? I might be flying up to New York. New York might be the safe place to be during that time.
And you can follow Peter on Twitter at Peter Ghostin. Peter, any other place people could follow you?
Right. So Peter Ghostin, Peterghostine.
Peter, thanks so much. Good hunting, and thanks for giving us some great looks across the bed.
Look forward to
my trading warrior brother, Peter Ghostin. Everyone thank Peter for his presentation and sharing what long, hard-fought years of knowledge with us.
Thank you very much, Dale. Likewise.
All right, buddy. Thank you.
Later.
Adios. Okay, everybody. Had a pretty productive session, don't you think? I think it was a great session. Everyone enjoy Peter? No, you liked it? I would take what he says to heart. I've seen Peter be right many, many times. And we still have the Euro trading in this channel, guys and ladies and everyone. Thank you very much for being here. Let me ask you, before you interrupt me, let me ask you, did you learn anything today? And was today fruitful for you to be hanging out in face? Was it fruitful for you to be hanging out in face? Then the way to show your appreciation of having a free room to get all this great analysis, Blake spending time here while he's trying to multi-manage a million different things, sign up today. You know, if you can't make it here, you can't make it anywhere. I know that sounds arrogant to people, but I've been around, okay? I've been around quite a long time. Oh, good for you, Dan. I'm glad you did it. So everyone who's been following me for years, I've helped you. This helps me for you to become a subscriber here at ForexAnalytix. So that's how you say thank you to me. Everyone have a great afternoon. Was that you, Steve, or Blake? Anyone want to close this off or say goodbye?
Oh, just thanks to everyone. It was a very productive interview. Also coincides, you know, with my view that we might still have some upside because what Peter actually told us is that he expects a little bit more upside to the main indices, and you know, then belly up, more or less. You know, that's my view as well. But you know, the guy is excellent.
Everyone thanks Steve for helping me. As you can tell, I'm still fumbling around this GoToMeeting room a little bit. But you don't know how hard he works. And everyone that knows me knows about my technical prowess, all right? My technical prowess, I was drag kicking and screaming into the 21st century. So remember, sign up. It's great working with you. We didn't have any time for screenshots, but we will. You guys are going to get involved. It's not always going to be just us. So thank you for your attention today. According to me, time is our most precious currency. Money comes and goes. Time is gone forever. Thanks for spending some of your precious currency with us. And thank you for your help, Steve.
Bye-bye, Dale. It was a pleasure. Bye-bye, my friend.
Thanks, Dale. Thanks, everyone.
Bye-bye, Blake.
All right, Blake. Thank you, buddy.
Bye-bye.
See everyone tomorrow. Sign up.